Okay, start recording. Okay, so we're gonna go over the microeconomic class today, and today's number is gonna be the non-farm payroll and the jobs number, and also the unemployment number. It's not unemployment number; there are unemployment numbers, but we're also gonna go on the wage control, wage prices. What does wages tell us, and how they react to the market. So we're gonna go two different things: unemployment rate and wage growth, and non-farm payroll. The first thing we're going to go through is the non-farm payroll. This is one of the things that Jerome Powell looks at every meeting, because that's what the latest decision was based on. The interest rate cuts was made on the non-farm payroll. So what is non-farm payroll, and how does it affect the stock market over the short term, the long term view? How is what is the pressure of wages and jobs on the stock market? So I'm going to bring those numbers in front of you in the Forex Factory. So I'm going to bring Forex Factory in front of you. So what we're going to do is quickly to first of all explain what is non-farm payroll. So what is non-farm payroll? It measures monthly change in the jobs outside of farming, government, and private households. So it basically tells us what kind of jobs are available. Are there more jobs or less jobs besides the government, besides the private households? Private households are those people that have created their own jobs at home, right? We don't count those in the non-farm payroll. So basically, non-farming, government, and private households. So exclude those jobs, and that's what we are looking at the market for. What's happening in the market? Are the jobs increasing or decreasing? So basically, what is the market impact on those? So let's take a look at the non-farm payroll. So we're going to do a little bit of research here. We're going to go to the U.S. non-farm payroll. This comes out once a month, and how does it affect the market? So here it is. This is what's been going on in the last year in the non-farm payrolls. We are losing jobs in the market, and you can see that by looking at these histograms that are going lower and lower. There are more loss of jobs in the market and less jobs available. That means the economy is going to the downside. So if you look at the bottom here, you can also see the actual numbers that have gone down over the last throughout almost like 3 years. And this is what Jerome Powell was worried about, this going into getting worse and worse. And that's why he cut the quarter point, not because of inflation or any other numbers. He looked at the PCE numbers as well, right? But overall, he was really worried about more and more job losses coming up in the next months. So he cut the quarter point. So this is usually what is the impact on the stock market. Now, when you're looking at the jobs number, if they're decreasing, that means your economy is going to the downside. That means the economy is not expanding, less and less jobs in the economy, and also you will see your GDP numbers go down too, because the productivity usually goes down as there's more loss of jobs happening. So this is what's the impact on the market. If it's a strong number to the upside, if there's an increase in these jobs, a strong upside surprise, economy is resilient. That means your economy is running hot if these jobs are like this way back here. And if the jobs get less, this economy go to the downside. So what does a strong number like this mean? Strong number like this means is your bond yields are going higher. Okay, that means your bonds are doing well. It also makes your U.S. dollar stronger. That means, if your economy is doing well, your U.S. dollar is going up, right? And it also makes your stocks on the pressure on the stocks. That means the stocks are corporations. And if they have lots of jobs available, that means they are very strong. They're making profits, they're making good revenue, and that is making your stock market go higher and higher. Right now, the stock market is going higher and higher on just several stocks that are running on AI, basically. Okay, but everything else is pulling this market to the downside. The overall market, that's why we're saying the market is going to the downside, but yet the stock market is going to the upside because it's run by very few stocks. that is pushing the market to the upside. That's why they started cutting interest rates, because underlying market is to the downside. Means we could be in a recession, but we are not showing it. Why are we not showing it? Because everybody's looking at the stock market, right? But yet we look at all these job losses, look at all the transportation, look at CNR, look at the trucking industry, look at the retail sector. They're all hurting. It feels like we have a recession out there, but yet when we look at stocks like Google and stocks like Microsoft, the 7 stocks, they're telling us that the market is going to the upside because they got jobs in their sector, right? But overall, the jobs are going to the downside. So what happens if the number comes in weak? That's what we are getting right now in the non-farm payroll. What is we getting weak? It's cooling the economy. Underlying economy is cool, but it's just the stocks that are running to the upside. So that's why we're cutting interest rates, which helps. Once we cut interest rates, it usually helps fire up the stock market. And it is. It's fueling the stock market even higher when it should not be, right? We're pushing the prices even higher. That's why I am afraid of these market prices are going higher and higher, but eventually, they're going to get overpriced somewhere. Somebody's going to have to pay the price, where it's going to all of a sudden going to have a crash. Why? Because the earnings will not be there to support these stocks. Okay? If the earnings are not there to support these stocks, then the market usually comes to the downside. So, and there's only few that are stocks are again pushing the market higher. Okay, sectors to watch when we are lowering and raising interest rates because of the non-farm payrolls. So if the non-farm payrolls benefits is if there is a strong cycle like industrial consumer discretionaries, those will benefit if we are from the strong growth in the job market. Okay. So we need to look at these numbers, and you can see right here, as they're going down, we are not doing well in jobs. We need to cut interest rates, and that's if we cut interest rates, that will, corporations like in the small corporations will borrow more money, and they will create more jobs, and hopefully this pace will pick right back up to the other side. Okay, that's what non-farm employment numbers do. Also JOLTS and job number. We also look at these numbers. These are total number of openings in the last month. Okay. If you look at the jobs month, they're also been going to the downside. So if you look at these numbers, they've been getting worse and worse as we are going, forward. And these are number of jobs in the previous month. So if they're coming in less, that means they're decreasing number of jobs, less jobs available out there for people, and that's what hurts the market as well. So there's 2 indicators. You can see the non-farm payroll, and you can also see the JOLTS numbers that are going to the downside as well. Okay, what about these are very clear to see. You can see the graphs right in front of you, what the economy is telling us. Very simple. Okay, so when you combine it with the PCE, you combine it with PPI, you combine it with CPI, you combine it with GDP. When you combine all these numbers and you start looking at paying attention to what direction they're going, you're going to be able to see the market overall, what direction the market's going. But it's not telling us that. Right now, the way the market's going to the upside, it's not telling us that. Okay, the market is telling us, when we look at Meta, we look at Google, those stocks are pushing to the upside, but overall underlying market is actually bleeding. It's into a recession. Okay, that's what these numbers are telling us. So what about the wage growth? Wage growth has been pretty resilient actually, because we had signed off contracts. The union signed in the last 3 years. All those strikes when there was inflation that was high. A lot of unions signed like a 15 to 20% wages. Remember UPS when it was trading $185 and the stock now is below $100, somewhere around $80-85 because of the wage pressure. Okay, the wage pressure has been to the upside. So let's take a look at the wages. What are the wages and how do they react to the stock market? So let's take a look at wage growth here. Let me search. here. Wages. Where is the wages? US wages. Okay, there is on. They usually come out on the same day as the non-farm payroll, so they should be part of this year's. Let me take a look. When did they come out last? Okay, they usually come in here. There is this. That's unemployment rate. This is what I'm looking for. Average hourly earnings. Okay, average hourly earnings is what tells us. That's what the number I'm looking for. So average hour earnings tell us the wage growth. What's going on? Are they going up or are they going down? So what does the wages mean? If the wages are going up, that is pressure on inflation. That means the inflation is going up. People have more money to spend, right? When people have more money to spend, they go out and they push the retail sector, a lot of other sectors to the upside, and it pushes the market to the upside because your economy is doing well. Its average earnings are growing, and that's what this showing us. For the last actually couple of years, the wages have been going, inflation has been going up. If the inflation is going up, what have been going into the interest rate? They've been holding pretty much tight, waiting for the inflation to come down, right? So overall, if we're also looking at the unemployment rate of the U.S. right now, this was on last Friday there on September 5th. Last month were 4.3. Pretty soon, the first week of next month, October, we're gonna start seeing these numbers again. So average hour earnings are they going to the upside because of they've been holding pretty steady, really. They haven't really budged much. So they have not been telling us very clear picture from wages. Wages basically tell us if they're going up, your economy is doing well, people are making lots of money, but here they haven't really gone up a lot, they haven't really gone down a lot. So the wages didn't have a lot of factor like the unemployment numbers had. Okay, but if these numbers were increasing, they were going to the upside, we would be having an inflation increase and the interest rates would be going up, not down. So basically they're going to the sideways. Again, if these numbers were going to the downside or the upside, that would have direct effect on the inflation rate, inflation reading, right? So that's a number. You want these numbers going lower, usually for interest rates cuts. Okay, so that is basically what unemployment and your wage and your unemployment rate affects, how it affects the market. Again, non-farm payroll, ADP numbers, they come out 2 days before actually the non-farm payrolls. So they came out probably on September 3rd. If you look at September 3rd, ADP non-farm, just there's your JOLTS numbers, the total number of openings on the previous months. And you probably hear, no, actually, maybe they came out on Thursday, I think. Yeah, there's your Thursday ADP numbers. I believe in these numbers. These numbers come from a private sector. They do the same thing, but they come from the private sector. The non-farm payroll comes from the BLS. They come from the U.S. government. I believe these numbers might be more correct, much better, but they show the same thing what the non-farm payroll showed. You can see those numbers are pretty much going to the downside as well. Okay, so that is the effect that this market has on the stock market. Any questions about these numbers or anything I talked about? I either confuse you guys all or we talk about it every single time that we bring these numbers come out, what they mean. So it's very important to understand them, and that's what makes you as a complete trader. And you'll be able to see the market better, what direction the market's going. Okay. I'm going to stop recording this one and I'm going to put this up if anybody wants to review it later on. It's trying to close.